You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
And despite this strong gold price environment we're in, a lot of juniors in the gold space are still really struggling. They're really struggling to raise money. And so you have this, that to me shows we're not in a crazy bull market. No, a crazy bull market is moose pasture in the middle of nowhere, being able to raise $30 million at a drop of a hat. And to me, that's the sell signal. So by no means are we there. And we have not yet seen the generalists enter the sector. And that's the other side of a bull market is when generalists enter.
Welcome to Mining Stock Education. My name is Brian Lenny. Today with me, I have Nicole Adshead-Bell, Director at Cupel Advisory. In our conversation today, you're going to hear Nikki's views on recent M&A, copper and gold markets, and which habits you should be discarding in 2025. Nikki, it's an absolute pleasure to have you back on the show. Thank you for coming on. Before we get into the real mining-related conversation, I thought we'd start off with sort of probably the biggest news item worldwide is the U.S. presidential election, and whether you think there will be any effect on the resource sector depending on how that election goes.
Yes, I'm here in Australia visiting family, and it's a very big daily topical conversation here as well. I think that if the Republicans get elected, if Donald Trump gets re-elected, that is more positive for the resource extraction sector than the Democrats. He has been very clear in his messaging around that. You have had this overlay with the Democratic Party over the last 3 years talking about critical minerals. And copper, oddly enough, was very late to that critical mineral list. So they've said that they want to encourage investment in a critical mineral sector, but yet some of their behaviour would indicate otherwise. And perhaps the most recent example of that is Antofagasta's Twin Metals in Minnesota, where they'd spent, I believe, around $400 million on advancing that project for it to be kiboshed at the permitting level. And so I feel like governments, and America isn't alone in this, you're seeing this elsewhere in the world, that say we want to invest and encourage natural resource investment, but yet are making that very, very difficult from a permitting perspective. Right.
Yeah, it should be really interesting to see how that all breaks down. Last week, Newmont came out with their Q3 earnings. And I think surprisingly to many, they failed to meet expectation. The share price reacted as such and came back. From what I read, I don't follow the company that closely. It was related to their secondary projects. And we've seen Newmont offload a couple of those projects in the last couple of months, actually. How important is it for these major companies to take these secondary projects, the less focused or marginal side of their business, and to put them out for bid for those mid-tiers and those kind of aspiring developers?
It's a very sensible strategy. I think when you look at large companies, and I think that this problem can be alleviated, it just never seems to be. I think all large companies suffer from size in some ways, as odd as that may sound. And so sometimes size isn't the most important thing. And so, and when you become big and you look at, it's a little bit like a government entity. It becomes about process and not productivity. And you have layers and layers and layers of management. And you speak to people who are friends of mine and former colleagues that are working in large companies. And there's a very common theme with working in the majors, and that's a frustration about your ability to get things done because of the decision-making process. And so when you're extremely, I do think larger companies can retain nimbleness. They just tend not to. It's incredibly rare. And so when you're very large, just by the nature of the beast, your smaller assets will get not as much attention when it comes to capital allocation, etc. And so as they manage their business, it makes a huge amount of sense. And then you have this mid-tier group that the easiest way to grow your production, and I would argue we're now in the part of the cycle. We've got strong gold price environment. Investors are starting to get more enthusiastic about the sustainability of that gold price environment. And we've shifted from this focus on balance sheet to a focus on growth. And the easiest way to growth is to acquire something. And so it's, in my opinion, it's two great needs meeting. And Newmont has been very, very clear about a sales process that is ongoing with its non-core assets.
Right. So at the high level, the seniors, obviously, you could concentrate on quality and that sort of thing. I was pitched by a Nevada junior CEO the other day, and he was telling me that from his contacts that senior gold companies are pivoting from size and moving to margin. And I wonder, does margin definitely has a tendency to be on the quality side? You know, high margins is definitely going to typically be on the higher side of the quality spectrum, but sometimes it doesn't always meet the size, meaning the resolution to making a difference on the underlying balance sheet of the senior mining company. Do you think, first of all, is that true? Or if it is true, how does that change the M&A landscape moving forward?
No, I would probably take a different position. Size does matter, and it's not just size, it's longevity of asset. So we live in a business that if you're mining, your asset's constantly depleting, and you have to replace that depletion through either organic growth or acquiring it. So what you have seen with the three largest gold mining companies in the world, with Barrick probably being the most overt about this. So Barrick, Newmont, and Agnico have all professed a desire to move into copper. There is some frustration on the fund management side when you speak to gold fund managers about that, because they're going, hang on a minute, you're a gold company. So if you cannot be positive about your underlying commodity, how on earth do you expect investors to be? But the positive about a certain suite of asset class, which is the porphyry copper gold, is they tend to be very large and they tend to be very long lived. And so if you can go and build or acquire an asset that has got a 20, 30-year life of mine versus the average gold mine, which is 10, you are on an NPV basis, on a valuation basis, it's hard to value long-lived assets. But from a company long-term strategic perspective, there's value in that. So I think when companies talk about tier one, they're very, very rare. Every junior says they have one, but they're an end member sector. And so tier one is jurisdiction as part of a tier one classification, i.e. can you permit and retain ownership of an asset? But it's in the top quartile in terms of size, in terms of life, and in terms of cost profile. Now, in a bull market, people don't care about margin. Investors don't. They care about torque. And so, ironically, the worst companies perform the best in a crazy bull market because they have the most leverage to gold. So, a company that has a very high cost structure has its percentage exposure to increased gold prices is more than someone who has a very well managed business and a low cost structure. And it's somewhat ironic, but the companies with the weakest balance sheets and the highest cost structures will outperform. So what I think, I suppose my personal bias is I think that investors and companies behave the same way wherever you are in the cycle. We never learn from our mistakes. And I think if you accept that, there's an enormous opportunity to create value for yourself in terms of how you invest. And so as a cycle matures, and we're not at the very beginnings of a bull market in gold, there's been obviously a lot of great performance in a certain asset class within the gold sector. But as people start become more enamored and generalists get approached to the sector, their focus becomes on growth. And we saw that last cycle. And then when the investors are demanding growth and companies have to go and grow, they can't do that through the exploration bit. They have to do that through M&A. And that's when you tend to see the feeding frenzy of M&A, and you tend to see crazy prices that are being paid for assets. So, but there is if you want to talk about a company that I think executed absolutely perfectly started off as a single asset junior, it was an Australian company. And when I was quite close to where I used to work for a precious metals fund, and we did a lot of work and did a lot of tie kicking. But they executed perfectly because they grew through acquiring assets that were being sold by majors, but they did that in a bear market. So they did that from 2013 and 2014, and that's Northern Star. And that is now a major in Australia. And they achieved that through acquiring small underperforming assets from Barrick and Newmont that had not got any love. And it was fascinating when you go and visit those assets and speak to those management teams, and that were fundamentally good assets, but were just being incredibly poorly managed, and how quickly they managed to engender outsized performance just through focus. So it's an interesting time right now. But the problem is, unlike when Northern Star was acquiring assets, that was in a very, very different gold price environment where gold pundits were saying gold price was never going to go above 1,500 ever again. I mean, that was a thesis back then, let alone get to where we are today. So you have, and you want to be acquiring assets when you don't have competition. Now there's competition. And so I think as you look out into the investable universe, at some point, the developers, they still do not have the love. At some point, they will get that. And you'll see massive re-rating as the larger companies start to trickle down the food chain to start trying to strengthen their own asset base in terms of size. Sorry, that was a long answer to a short question.
In terms of M&A trickling down, we saw a couple big deals earlier in the year, and it seems across the junior spectrum to have reached the lower market cap companies, and we're seeing Next Gold and Signal Gold come together. Minera Alamos, acquires Saber Mining, or possibly. What does this sort of M&A action tell you about where we are in the cycle?
I think that it tells you you're kind of at the beginning of that upwards talk in the cycle, and it's very, very sensible M&A. And number one, there's just simply too many companies, listed companies globally. There's well in excess of 3,000 resource companies, and the smaller end of the scale are all competing for limited capital and limited investor attention. And so theoretically, I'm not saying this always happens, but theoretically when two companies get together, their corporate G&A, if they're a producer per ounce of production, should go down. It doesn't always. And also their burden of being listed declines. And so it makes a huge amount of sense for M&A to occur. And the investing community, the fund community, has been very frustrated in the past as to why that doesn't. Now, with the advent of the ETFs, and that's the big difference between this cycle and last cycle, is the influence of the ETFs. Is size does matter with ETFs, and it does matter when you're trying to attract generalist investors. And so if you go and speak to a generalist, for them, small cap is $1 billion. So, that they might, and I just recently spoke to some New York-based investors and was kind of pitching them on a company I'm involved, and they said, "Oh no, it sounds really interesting, but it's way too small for us, and come back to us when you reach $500 million." And so consolidating strategically makes sense, it economically makes sense, and it makes sense from attracting a wider capital base. And despite this strong gold price environment we're in, a lot of juniors in the gold space are still really struggling. They're really struggling to raise money. And so you have this, that to me shows we're not in a crazy bull market. No, a crazy bull market is moose pasture in the middle of nowhere, being able to raise $30 million at a drop of a hat. And to me, that's the sell signal. So by no means are we there. And we have not yet seen the generalists enter the sector. And that's the other side of a bull market is when generalists enter. And I think what you'll see is we are seeing true margin expansion now. We have just come from a very highly inflationary environment. Costs have stabilized, in fact, are probably slightly trending down. Let's see what happens with Iran and Israel, because obviously if there is material issues there, impacts oil production, oil goes up, that's very inflationary. But you're seeing true margin expansion. And I think you'll have to see 2 to 3 quarters of that margin expansion with a growing gold price environment. All of these companies, the producers, are trading at very, very low multiples. That will start to attract the generalist investors. And they're normally later to the game.
Lithium was one of the hottest markets over the last few years. Like any hot sector, the high prices are a cure for high prices. Do you have a view on the lithium market and where it might be headed in 2025?
So I completely missed it. So perhaps I'm not the smartest person to be asking about this, but I wasn't alone. And this is where we as technical people have challenges, because we look at things through the lens of reality. Yeah, investors are mostly not technical, so they look through that at a different lens. And we all went, there's a hell of a lot of lithium in the world. You don't have a supply. It's pretty quick to bring on in terms of, particularly on the brine side. So you don't have a true shortage of supply. What you had was a demand spike and a lag in production. And so the market very rationally did what it should do, which was massive escalation in lithium price. That encouraged huge amount of investment into the sector, all at the same time, and suddenly production increased materially, and of course the price went down. I don't think lithium is going to reach those heights again, frankly. That price increase did what it needed to do. We are not yet set on what is going to be the ultimate battery technology. We still have got competing battery types. I think lithium will be part of that mix, but I don't see near-term price pressure on the lithium price and therefore the equities. There is a bit of a resurgence of interest because Rio has made, which is not a surprise. I've been very clear about expressing interest in the sector, and frankly, unusually for a major, investing now is much smarter than what it was 2 or 3 years ago. So for me, that's a less attractive asset class than, say, copper or gold.
For sure. In our last conversation, copper was, I think, the main focus of what we talked about. Is copper still a high conviction metal for you right now?
No, absolutely. And I'm somewhat astonished that the price isn't performing better. And as I work through maybe what that is, production starts to materially decline starting next year. And I'm not alone in saying that. Every single forecaster says exactly the same thing. And to incentivize new production, you need a higher copper price. And I think that copper price, I was saying 2 years ago, everybody thought I was nuts, $6 to $8. Now other people are starting to say to $6 to $8. I would argue it's probably more around the $8 mark. You are not seeing material investments. What you are seeing is copper companies getting together. You're seeing M&A in the sector, but you are not seeing material capital investments in new growth. And we absolutely need new growth. Copper is it's the key critical mineral. Without copper, none of move to net zero, industrialization, all of those good things. I think it's way more critical, for example, than lithium. Without copper, no lithium batteries exist. And so I think we're in this perfect storm, and oddly enough, in this perfect time to make investment decisions into the sector, because at some point the globe will go, holy crap, we need copper. So we need to invest, and the copper price will talk. And what we've seen it in uranium, we've seen it in lithium, we've seen it in every single bull market. That price talk, I don't think that's predictable. I think it might be predictable kind of within a year, but it goes harder and faster than anyone will see, and the equities obviously will respond to that. So I think that there is this very unique time with copper. No, I'm a massive crazy copper bull. I think that, and I am very, very biased. I'm chairman of a copper developer called Hot Chili that's got a very sizable copper development project in Chile. So I'm very familiar, I suppose, with what's going on in that part of the world. And not only does it have a copper project, it's in low elevation. And so the Filos of this world and NGX is fantastic discoveries. Those companies done an awesome job on creating value through the drill bit, but they're all at high elevation. And so their timelines to production, obviously they're relatively early in that discovery cycle, but their timeline to production is pretty material. With those on low elevation, you're more endowed. Your economic hurdle is lower because you have a plethora of existing infrastructure. It reduces your capex and your opex. And then the key in Chile is water. And not just in Chile, everywhere else in the world, water is the most sensitive issue. And Chile, you can no longer extract continental water in Chile. So that means that you cannot extract any water from rivers or from aquifers. It has to be from the sea. And so Hot Chili's project, it's amenable to seawater processing, but to get that seawater extraction permit takes around about 10 years. It took Hot Chili around about 10 years. And so no water, no project. Or as one of our Chilean guys said, he said, no water, no project, no money, no honey. So
was that Jose?
It wasn't Jose.
Okay.
So we kind of have this, what we've realized is this asset that in and of itself is incredibly valuable, because that can speed up development of projects within a 150 kilometer radius of us that do not have their own water license. And if they were to start that process today, they're looking at plus 10 years. And so it's kind of fascinating when you look around the world. Even if you want to build a mine today, you have those permitting timelines. So for me, that just puts more and more and more pressure on that underlying commodity price.
Wow. Yeah, Christian and Jose are amongst some of my favorite people in the sector.
Yes.
When talking about copper, the focus is usually around the porphyries, and for good reason, given the size and our conversation earlier. But where do the higher grade, lower tonnage products fit in? Are these companies being recognized by the market, or is there opportunity there in your view?
Well, Forum's being recognized by the market.
That's right. That's right, in a big way. In a big way.
In a big way. Look, well done to that. Well done to the company. They've done a superb job of creating value. And again, back to my comment at the start is every company says they're undervalued, and that's impossible. And really, your job as a management team is to try and get your company as highly valued, so trading at a premium to NAV per share as possible, because that gives you enormous flexibility to transact with your paper. And that's either buying something else with your paper that is overvalued and buying something that is undervalued, or it's issuing equity. Forum is a relatively small production profile. Obviously, it's got grade. It's got very well-known backers behind it. It's in Canada, so there's some love for that. So they've done an absolutely superb job of creating value per share. So if I was them, I would also be thinking about how to use that value.
For sure. And I guess the way I sort of looking at it is like, especially if the mid-tiers wanted to follow the seniors, and I'm talking about gold mid-tiers, these higher grade, lower tonnage projects have lifespans and CapEx more along the lines of a gold project, 10
That's
years
right.
and $500 million CapEx. So to me, it seems like the jump isn't as crazy as saying, I'm going to go from, I'm a $2 billion mid-tier gold miner, and I'm going to go take on a $2 billion CapEx project in Ecuador or something like that. So it's interesting.
It is. No, but I do think it's worth just touching back again on the gold side of things is one of the reasons why I think that gold miners, it's not just the duration of asset class with the copper gold porphyries, why they're talking about copper. It's also in the last 4 years, there has been an inordinate amount of focus on ESG. And I would argue in a capital destructive, unhealthy focus. And so you've had all of these ethical funds and ESG funds and this rhetoric around the move to net zero. I would argue that that's impossible, but that's a topic for another day. And so because of that and this focus on it, as a gold company, it's hard to talk about the E of that. Whereas if you're a copper company or if you're any kind of other metals company, you can normally twist yourself to somehow say, well, we're going to contribute towards net zero and the green revolution. And so I think gold companies they just weren't getting the love. And so instead of being creative about how to message their business in a way that's palatable to the other side, which is on the yes side, for example, yes, do we need more gold? Almost all the gold that's ever been mined is in existence today, but it's a unique asset class. And look at Bitcoin and look at cryptocurrencies and kind of compare their utility and their value and what they bring versus a gold mining company. And so gold mining companies provide a huge capital injection to local economies. Normally public mining companies, government owned and private may be different, but employees are paid on average higher. There's the multiplier effect. So there's all these good things that gold miners could be talking about, but they have to be creative. And so I think that has also explained this shift with the majors that are very strongly messaging copper. But my rebuttal to that is, if I want to invest in copper, I'm going to invest in a copper company. I'm not going to invest in a gold company that's exposed to copper because I want the most talk to copper. So I do think some of these companies do have to be careful about their messaging, because if the generalists are waking up tomorrow and going, I want to invest in gold, I mean, simplistically, they're just going to go to the largest companies that produce the most gold, essentially, and clearly message that they're a gold producer. And so messaging, investors react to packaging, and messaging is very, very important.
How will so back at the beginning of the year, Solaris had a block of Zijin Mining's investment into their company, or Wawinsa, the project. This effect seems like it could has the potential to snowball across the sector. In your view, how does the re-domiciling of a company like Solaris out of Canada affect the Canadian market moving forward?
It's huge. The government overreach with that to me is unbelievably shocking. Every country will have a foreign investment review, in Australia, for example, FIRB, the Canada Investment Act, where they are looking at investments in assets and opining on who can invest in assets in their own country. Now, that's understandable. That's your resource. That resource will deplete it. You have physical ownership of that. To then extend that decision-making on assets in another country, I honestly can't believe that this isn't discussed more. It is unbelievable government reach. It is very, very detrimental to the Canadian mining sector. So when you think about a company, private company that goes, we have an asset, say a copper asset here elsewhere in the world, it is our fiduciary duty and our duty of care as management and board to create as much value as we can for all stakeholders. Now, if that value creation is from a Chinese entity, then we have to consider that. And so to preclude access to capital and preclude a company from conducting its business in the most appropriate way possible, aimed on fulfilling its duty, fiduciary duty and duty of care is absolutely shocking to me. And so that means that companies will make a decision to not list in Canada. They will make a decision to re-domicile elsewhere. And for a company like Hot Chili that has a very sizable development project in Chile and a big water asset that both require material capital investment, we have a secondary listing in Canada. And so obviously what's gone on with Solaris is making us think about our strategic options as well. And what also is insane about it is Canada, they're focused on mining, but really it's smelting that controls copper production. And China controls 50% of smelting capacity in the world. Canada is, if I recall correctly, is the 18th in terms of smelting capacity, 15th in terms of primary copper production. And so if you really want to both have resources sufficient for your own use, you need mining and you need smelting investment. And I think what you're seeing is an incredible lack of understanding from the governments of how mines work, number one, what the cycle of critical minerals are. And at the end of the day, you're competing against China, which takes a longer term view than any of our governments do. Our governments are focused in democracies. They're focused on the election cycle. That's a 3 to 4 to 5 year window, depending on which country it is. Whereas I would argue China takes a 50 to 100 year view. And they took this view. There's a really interesting stat, because I just want to refresh my mind on the numbers. In 1990, Asian smelting was 21% of the 21% of the global, and it went to 69% of global smelting production. The Americas was 29% in 1990 and is now 10%. That to me is the change. And also we live in this world where everybody's quick to kind of say, well, you're sexist or you're racist, etc. It's kind of racist if you want to look at it that. You're basically saying that a whole group of people can't invest in Canadian-linked assets. And then the other if I was Ecuador in that, the Ecuadorian government in that case, I'd be having very, very serious conversations with the Canadian government going, who do you think you are? How dare you make decisions that impact our economy and our ability to attract foreign investment and to have capital injections and create new jobs and engender wealth from the resource sector? It's unbelievably shocking, and it's very, very, very negative, in my opinion. And I think possibly the basis for litigation.
South America is, when you start talking about porphyries and copper, it's synonymous with investing in South America. Chile, as you were saying, Ecuador. I've often been told, and I've thought this for a long time myself, is that you should understand a jurisdiction before you invest in it. But the question that I even ask myself is, how do you know if you actually understand a jurisdiction and everything that makes it tick? Do you have an opinion on that?
You mean as an investor, or do you mean as a company that's investing?
As an investor.
Number one, I don't think you will ever understand everything about everything. So you just have to accept that. And so as an investor, I feel like geologists actually have a natural skill set for investing, because geology is an inexact science, and you have to take pieces of information, come up with a workable hypothesis, and be willing to change that information in an iterative way as you are exposed to new information. And I think that's the same with investing in other countries. So I think if you're investing in, say, Chile, number one, I'd be looking at what the company's management structure and expertise is, because that de-risks it for you. And so I think we've seen too many gringo-run companies go into countries elsewhere in the world, and they don't have sufficient local expertise. And so I'm going to toot hot Chile's horn here. In Chile, every single one of our employees is Chilean. We have not imported an expat to manage the business, because you want to see people who speak the language, who understand the culture, who live in the country, who understand the regulatory environment. And one of the most senior people in the company, Jose, he's the EVP Chile. And so you also want to see people from locals that are in senior key decision-making positions. And so we also have a Chilean national who's on the board. And it was the same with Bravo, which is a company that we spoke to about last time. And Bravo, every single person in Bravo, other than two of the directors, was either Brazilian or lived in Brazil. And when you've seen what you tend to see with companies is when there's an issue, they often, it's easy to blame the country, not the management of your business in the country. And those are two very, very different things. And so a way to de-risk as an investor is to satisfy yourself that there's enough local expertise about how to conduct oneself in that country. I think that's very, very important.
We talked earlier about on the production side of things, how the low margin companies have the most torque in a rising metal price environment. Flipping to the investor side and looking at developers. So these are companies, there's no production, they're looking to develop into a producer. Is it time to buy optionality or are marginal ounces in the ground? Are we at that point yet?
It's a really interesting question, because the ounce in the grounds haven't moved at all. So there's two different ounce in the ground stories. There's ones that will probably never be a mine, probably not in our lifetimes, that have a huge ounce endowment, but because of their capex and cost profile, obviously price solves everything, as you said at the start. So those ones are generally, you own them in a bull market. And I did this back in 2016, beginning of 2016 into 2015. Now, I did not predict the gold price move in 2016. Nobody did. But at the end of 2015, everybody was essentially, who was exposed to the sector, was essentially suicidal, because the ETFs were down 85, 90%. If you were exposed to the sector, you hated it. You're never going to invest again. And for me, I just resigned from working for a gold fund. So it was kind of peak knowledge about the sector, but had the freedom to invest personally. And so what I did at that time, just when I going to buy, because my thesis was at some point in the next 2 years, gold will go up. Sentiment is so unbelievably negative. There's only one direction for that sentiment in the longer term. So I just bought leverage beta. And so I bought ounces in the ground stories. But my qualifier for that is they had to have enough cash on the balance sheet to last 2 years without raising equity. And that turned out to be a good decision. And they were on average probably up 200, 300% in 6 months. And I sold out of all of them by mid-2016, because when you see a price that goes like that, you need to be taking money off the table. So that has not happened yet. And I think part of it is we've kind of had this slow burn in the gold price. And to me, this is why I don't think we're in a crazy bull market, because at some point, you'll see all people want to talk about is ounces in the ground, and ounces, how many ounces, the ratios of market cap per ounce, that kind of thing. That will come again. I do think, though, that there are some companies that have got very, very poor balance sheets. So if you want to buy leverage beta, that is not a bad thing to do in a rising gold price environment, but you want to be checking balance sheet, because if they have to raise money, and it's still difficult to raise money right now, I think that there is a group of companies that are M&A targets that have development projects that are decent development projects, that what you see in the behavior in the larger companies is like merging with like. So producers with producers, it's low risk. And then producers maybe are acquiring a permitted, advanced, high-quality development project. And then nobody really wants to take on a lot of risk right now, but risk appetite will change as price goes up. And so I think the developers look very, very undervalued. And so at some point, and what you'll see is companies tend to be sheep-like in their behavior, is that the discussions, and it is as simple as this in some ways with boards and management teams, is one company does something and then the other company's going, oh, well, they did that. We need to do that too. And so you just see these themes of behavior in the sector. And you saw with a bunch of Aussies acquiring assets in North America that happened about 6-7 years ago. You know, almost every large Australian company went and acquired an asset in North America. You've seen it with, so BHP with the JV in Philo, and now with Nico's announcement with ATAX, which is proximal. So you tend to see these themes of behavior, and the developers will benefit from that. At some point in time, there'll be a feeding frenzy for them. And they will re-rate once they start getting taken in a high degree of abundance. Then they start trading at valuations that are based on the expectation of being acquired, and that they'll be acquired for a premium. So you tend to see them talk up before the actual takeover event.
What about the importance of a junior mining company having a strategic investor, whether that's a senior gold company or some of the more notable investors or families, the Lundins, the Barricks, Newmonts of the world? Seemingly some of the ways that I've made money this year have been on the backs of people like the Lundins, where the announcement of them being involved in the project in a bigger way makes a huge difference to the market's perception. So has the importance of that strategic investor become more important?
I think it's always been important. I think it's more important in this commodity price environment because access to other types of capital has been more limited. There's been less retail interest. You used to be able to go marketing in Toronto and have 2 full days of meetings with all resource funds. Now you're lucky if you have, anecdotally, one of the largest gold-focused companies in the world was in Toronto, and they only had 4 meetings. So you've had this, there's a more limited source of capital, and really when you have a lot of capital competing for finite product, that makes gold prices talk up. So I think there's two ways to look at this. Named investors, that is net positive, whether it's Rick Rule, whether it's Gentili, whether it's Eric Sprott, whether it's groups that are seen by the market to create value, rightly or wrongly. And when you think about it, it's a little bit irrational. Nothing in the story has changed. All that's happened is someone who people follow has invested. So, but they are very, very important source of capital, and particularly in the higher risk, smaller companies that have limited access to capital. When you look at a Barrick or a large company making a strategic investment, sometimes that's the only there's pros and negatives to that. The positive is one would assume that they have done pretty detailed due diligence. So you have an external validation of that project. Not always the case, because obviously there's politics in companies, and sometimes they make completely insane decisions and you don't know why. So there's that element. But then the flip side of that is they can be a negative for takeover anticipation and premium and share price performance. So if a Barrick takes a strategic position and it has anti-dilution clauses and it has a nominee on the board, it for all intents and purposes controls that company. And so if someone else wants to come into the mix, it's very, very, very difficult. So when you see strategic investments by corporates, it's really worthwhile just reading the press releases and understanding the nature of that deal. Have they bear hugged that company so that company cannot incentivize external competition, which is what you want to do. Whereas if it's a traditional equity investor, they're there to make money. So that's good for you as a shareholder. And the Lundins, look, they have done an unbelievable job creating value, incredible exploration success. They put their money where their mouth is. So I think, but they also are willing to sell. I mean, and you've seen that time and time again with the family companies, whether it was with Redback, whether it's obviously the Philo JV. So I think that they're very sensible in terms of of how they conduct their investments or their management of companies. So to me, that's kind of a hybrid one. I would be more comfortable in some ways with a Lundin versus maybe a Barrick, depending on the structure of the deal.
I heard a good quote the other day referring to habits, and I'm going to paraphrase it, but it basically says, depending on what they are, our habits are what make us or break us if we repeatedly do them. And looking out to 2025, I was wondering if you could give us your view on what habits investors should get rid of or cut from their process to be more successful.
Almost every investor struggles to sell. So the habit to get rid of is owning stocks in perpetuity. So we're all very good at buying, and we're very, very bad at selling. And ironically, it's often the high performers that people don't sell. So selling, getting rid of the habit of owning stocks. I think Rick Rule has said it, you rent them, you don't own them. And it really does depend where you are in the cycle. And if you have made money, any kind of money, you've done incredibly well. Just always be looking at not just focused on where could it go, and also being very honest with yourself. So a really good habit to have is when you buy something, write down the reasons why you buy it and what share price you think it's going to get to if it executes on the reasons and why you buy it. And then go and look at that on a regular basis, because share price that often move for completely different reasons as to why you bought them. And if that has happened and it's a gift, act on that. So yes, for me, it's the selling side of the equation that we all get wrong. I've been guilty of it too.
Yeah, same here. I completely agree with you, and I can't echo that what you just said enough. It's so very true. Nikki, it's been an absolute pleasure. Thank you so much for coming back on the show, and I look forward to chatting with you again.
Thank you very much, Brian. I really appreciate it.